For many investors, every macro release feels like a separate earthquake. One day it is CPI, the next day it is NFP jobs data. Between them, you have FOMC meetings and endless speeches from central bankers. Each event seems to demand an instant reaction. If inflation comes in hot, panic spreads through every chart on the screen. If it comes in cool, people rush to declare a new bull regime. The pattern looks chaotic from the outside, but underneath, the Fed is trying to manage one simple thing: the cost of money across time and across the whole economy. Interest rates are not just numbers on a policy statement. They are the reference point for every loan and every valuation, from mortgages and credit cards to corporate bonds and startup funding. When the Fed adjusts its policy rate, it does not move everything directly. Instead, it nudges the entire system through a chain of transmission. That chain runs through bond markets, credit conditions, and business decisions. Most of the violence you see in markets is that chain adjusting. Yields move, risk appetite shifts, and liquidity becomes easier or harder. Asset prices simply reflect those deeper shifts in discount rates and confidence. If you only look at the headlines, you mostly see noise. You see arguments about one decimal place for inflation or unemployment. You see commentators fighting over what a single sentence from the Fed means. This video takes a different approach. Instead of reacting to each number, we map the whole mechanism. We will treat each macro event as one step in a longer process. First, we will walk the policy transmission chain from Fed decision to real activity. Then we will look at the expectations channel and forward guidance. Finally, we will place individual events inside tightening and easing cycles. The goal is simple but important: to shift you from trading headlines to understanding regimes, from reacting to noise to recognizing where we are in the cycle. When the Fed changes its policy rate, almost nothing happens instantly. Most households do not feel a direct shock that very same day. The real impact arrives through a chain of adjustments. The first link lives in short-term money markets. Banks and large institutions lend to each other at floating rates. Those rates closely track the Fed's target range. From there, the move spreads into government bond yields. Investors reprice treasury bills, notes, and bonds across different maturities. The entire risk-free yield curve slowly shifts up or down. That curve is the anchor for almost everything else. Mortgages, corporate bonds, and many loans price off its levels. Higher treasury yields usually mean higher borrowing costs for everyone. As borrowing becomes more expensive, credit conditions start to tighten. Banks review lending standards and risk departments become more conservative. Marginal borrowers find it harder or more costly to get credit. Companies feel this in several ways. Issuing new debt becomes less attractive or even uneconomical. Refinancing old obligations can also hurt more than before. When financing is painful, expansion plans are delayed or canceled. Hiring slows, capex budgets get trimmed, and projects lose urgency. Cash preservation becomes a louder internal priority. Households face their own version of this chain. Mortgage rates move higher, credit card rates increase, auto loans tighten. Large purchases become tougher to justify or to service. Slower borrowing usually means slower spending. That is exactly what the Fed wants during overheating periods. Less demand reduces pressure on prices across the economy. The important detail is this: the Fed is not targeting your favorite asset directly. It is trying to influence aggregate demand through the credit channel. Financial markets anticipate each link in this process. Bond traders move before banks change loan offers. Equity and crypto markets move before the real economy slows. That anticipation creates the violent price swings you see. Markets are constantly guessing how long and how far tightening will run. They are also guessing how much the economy can absorb before breaking. Understanding this chain changes how you read macro news. You stop treating each rate decision as a random shock. You see it as one more adjustment along a known path. Markets do not only react to what the Fed does today, they react to what they believe the Fed will do tomorrow. That belief is constantly updated by data and communication. This is the expectations channel. It explains why sometimes a rate hike triggers a market rally, and why a pause can still cause risk assets to sell off. Investors care about the path of policy, not one meeting. They ask where rates might peak and how long they might stay there. They also ask how quickly easing could arrive after the peak. Every FOMC decision carries two layers of information. The first layer is the actual rate move: hike, cut, or hold. The second is the message about future intentions. That second layer appears in the statement and press conference. It also appears in the dot plot and economic projections. Together they form the Fed's forward guidance to markets. Inflation and jobs data act as regular tests of that guidance. A hotter than expected CPI print challenges the current path. A weaker than expected labor report challenges it in another way. Markets compare each data release with prior expectations. The surprise versus consensus often matters more than the level. Small surprises can move yields and risk assets very quickly. In this setting, traders focus on probabilities. They track implied odds for future meetings across the curve. They infer a likely terminal rate and easing schedule. When new information arrives, those probabilities are repriced. The result is visible in bond yields, currency moves in equities. Crypto and other risk assets often respond to the same repricing. This is why macro can feel like a never-ending shock machine. Expectations are constantly revised, not just at official meetings. Speeches, interviews, and even small data points can shift the narrative. Seeing this channel clearly changes your interpretation of volatility. You realize the market is not reacting to data in isolation. It is reacting to differences between new information and prior belief. For long-term investors, this suggests a useful mindset shift. You do not need to game every expectation adjustment intraday, but you should understand the broad direction of market beliefs. Over cycles, that direction helps define the macro regime. It tells you whether policy is moving toward tighter or looser conditions, and how surprised markets still are by that trajectory. Instead of tracking individual meetings, think in terms of regimes. The Fed usually moves through recognizable cycles over several years. Each cycle has a tightening phase, a plateau, and an easing phase. The tightening phase begins when inflation or overheating become persistent. Policy rates rise from low or neutral levels toward restrictive territory. The goal is to slow demand enough to cool price pressures. In this phase, financial conditions generally become less friendly. Yields rise across the curve, credit spreads often widen, liquidity thins. Risk assets struggle to sustain rallies without very strong fundamental stories. Eventually, the Fed reaches a point that feels restrictive enough. The policy rate stops rising and enters a plateau or hold phase. Real rates relative to inflation often remain tight during this period. Here, the focus shifts from how high to how long. The key question becomes duration of restrictive policy. Not just the peak, markets debate whether the economy can handle higher rates for extended time. If growth and employment hold up, the plateau can last surprisingly long. If stress builds in credit or labor markets, pressure to ease appears sooner. Either way, macro narratives revolve around timing of the next transition. The easing phase begins when the Fed sees enough disinflation or weakness. Rates are reduced to prevent unnecessary damage to jobs and activity. The goal is to move back toward neutral or slightly supportive conditions. Historically, this phase can be complex and uneven. Sometimes cuts arrive into clear recessionary environments and collapsing demand. Other times they appear preemptively to avoid deeper damage later. Across the full cycle, markets constantly reprice path and speed. They ask where we are on the tightening curve today. They ask how far we are from plateau and eventual easing. Placing each FOMC, CPI, and NFP into this framework is powerful. You stop reacting as if every print defines a new world. You start asking how each piece shifts the cycle map. For example, a slightly hot CPI deep into a tightening phase means one thing. The same number near a potential easing phase means something else entirely. Context within the regime matters more than the raw figure. For long-term investors, this framework offers a calmer anchor. You focus on which phase we are likely inhabiting, roughly, not on predicting the exact wording of the next statement. Macro data and Fed meetings will never become quiet. The flow of information is designed to be continuous and reactive. Your edge comes from how you structure that flow in your mind. At the surface level, every event looks unique and urgent. One CPI, one NFP, one FOMC press conference after another. Each one invites instant judgment and instant positioning. But beneath the surface, the same mechanisms repeat. Policy moves through the transmission chain into credit and demand. Expectations shift as new data challenges old assumptions. Tightening and easing cycles rise and fall over the years. Sometimes they are smooth. Sometimes they involve shocks. Yet the basic pattern remains recognizable over time. Moving from event noise to cycle thinking is a choice. It starts with a different set of questions after each release. Not, is this good or bad for markets today? Instead, you ask, what does this change in the transmission chain? Does it meaningfully alter the expectations path for policy? And where does it place us inside the current cycle framework? Most of the time, the honest answer is modest. A single data point nudges the picture but does not redraw it. Your long-term view can stay intact with minor adjustments. Sometimes the answer is more serious. A pattern of surprises may signal a real regime shift. In those moments, revisiting your macro map is rational. The key is that you respond from a structured framework, not from adrenaline, social media sentiment, or fear of missing out. You let the cycle model guide your interpretation of events. This does not eliminate uncertainty or volatility. Macro will always be messy, and the Fed will sometimes be wrong. Markets will still overshoot in both directions. What changes is your posture inside that environment. You become less dependent on the next headline for orientation. You rely more on a coherent view of policy, credit, and cycles. Over time, that posture compounds into a quiet advantage. You trade fewer impulsive reactions for more deliberate shifts. You connect local events to the global macro story. The data calendar will keep moving, week after week. But you are no longer living from one release to the next. You are tracking a longer journey of tightening and easing. That is how long-term investors survive in a short-term world, not by predicting every print, but by respecting the cycle, and by letting macro inform decisions without owning their emotions.